Hey folks, let's do some variable costing and absorption-based costing income statements. So it's the same stuff we've already been doing. The variable costing separates it out where you have contribution margin. The absorption-based costing is the traditional income statement that we've been doing all along for external purposes. We're just going to add one new concept and we're going to apply it 3 different ways. Okay, so variable costing and absorption-based costing income statements include both product and period cost. The variable costing income statements use a contribution format and the expenses are based on cost behavior. Absorption-based costing income statements ignore the fixed cost and variable cost, the cost behavior, and the expenses are classified as either a product cost or a period cost. And remember, the product cost are inventoriable cost. They go to inventory first and then to cost of goods sold when they're sold. And a period cost goes straight to the income statement and never shows up on the balance sheet. Okay, generally, variable costing net income will not be equal to absorption-based costing net income. And the difference is always due to accounting for fixed overhead differently in the two systems. So your job this chapter is to make sure that you can reconcile an absorption-based costing net income to a variable cost costing net income. And that's the whole idea behind what we're doing in this chapter. So variable costing can also be called direct costing or marginal costing. So the product cost for variable costing are your direct materials, direct labor, and variable overhead only. The fixed cost is considered a period cost and is expensed as it is incurred. So that's the difference between the two. In absorption costing, you might also see it called full costing. Product costs are the direct material, direct labor, variable overhead, and the fixed overhead. So what we're going to have to do is we're going to have to take that fixed overhead dollar amount and make it a per unit amount so that we can include it in the product cost. So to get it to a per unit amount, the fixed overhead dollars are always divided by the units produced that year. Not the units sold, not the units in ending inventory, but the units produced. That's important. If the inventory is not sold, the fixed overhead per unit goes to the balance sheet in ending inventory and not to the income statement as an expense. So that's the difference. Variable costing, every bit of the fixed overhead is expensed, period, in that year. If in absorption costing, if the inventory is not sold, some of the fixed overhead is over on the balance sheet in inventory and not on the income statement as an expense. Your selling and administrative expenses are always a period cost. They're never a product cost. And the selling and administrative expenses are expensed as incurred. Both the fixed and the variable selling expenses are expensed as incurred in the year that it happens. Okay, so we have 3 different situations. We can have production is greater than sales, production is less than sales, or production is equal to sales. And so one of the ways to look at the reconciliation is what I have here. So if inventories increase, which means you produced more than you sold, then your absorption-based costing net income will be greater than the variable costing net income. Okay, production is greater than sales because you have deducted all of the fixed overhead on the variable cost income statement, and you have not deducted all of it on the absorption-based costing. On the other hand, if the inventories decrease, so you produced less than you sold because you made too much last year probably, then your absorption-based net income is going to be less than the variable costing net income. So notice production, absorption-based. The direction of your sign is going the same direction. Production is less, absorption-based is less. If production equals sales, I bet you can guess what happens. Absorption-based net income is equal to the variable costing net income. Okay, so that's one way to look at a reconciliation of it. Another way is if you start with variable costing and you add the overhead that was deferred in inventory, or subtract the overhead that is released from inventory when you sell those units, then you have absorption-based net income. So in the homework, I've kind of shown you both directions of it so that you can understand the reconciliation more than one way. All right, so let's take a look at the 3 different methods. So the first one is if inventories increase, production is greater than sales. So we're going to produce 50,000 units and we're going to sell 45,000 units. And then I just made up some numbers. So sales price is $100 per unit, fixed overhead is $500,000, variable selling and administrative is $4 per unit, and fixed selling and administrative is $400,000. So the first thing you need to do is figure out your product cost for both variable costing and absorption costing. And I just made up the direct material, direct labor, and variable overhead numbers. Notice that I did not put any fixed overhead in the product cost for variable costing. It's only in the absorption-based costing product cost. And I took the fixed overhead per year, 500,000, divided by what we produced, 50,000, to get $10 per unit. So the absorption-based income statement is your sales based on 45,000 units sold minus cost of goods sold, and that's at your product cost of 40, gives you gross profit minus your variable selling and administrative cost minus the fixed selling and administrative. So your absorption-based net income is $2,120,000 in this particular example. Notice that I used a column for units, a column for price per unit, a column for total, and a column for percent. Just get in the habit of setting it all up like that, and then when you're given information and some is missing, you can always go back and figure out what's missing and figure out the dollar amount of it. Okay, so in a variable costing income statement, we take sales at the $100 per unit minus your cost of goods sold, and the $30 is your product cost for variable costing. Minus, you have other variable cost, which is your selling and administrative, to come up with your contribution margin. Then you subtract all of the fixed cost, the total fixed selling and administrative, and the total fixed overhead of that 500,000. So notice that our net income for variable costing does not equal the absorption-based costing net income. And there's a reason for that. And the reason is that production was greater than sales. We produced 50,000, we sold 45, so the difference is 5,000 units. The fixed overhead cost per unit that we computed earlier was $10, so my net incomes should be $50,000 different. So the absorption base should be higher than the variable. So if I take 2070 and add the 50, I should come back to the 2120, which is exactly how this works here. Not too hard, is it? You just have to remember what you're doing. When production is greater than sales, absorption-based net income is greater than variable costing net income. Okay, let's go to example 2. If inventories decrease, okay, so in this example, production is going to be less than sales. So absorption-based net income is less than variable costing net income. So production is 45 and sales are 48. Okay? Same sales price. I did change the variable overhead so that it would remain at $10 per unit. It's not always the case that way. Everything else stays the same. So absorption costing income is sales at the $100 less the cost of goods sold at its product cost of $40, gives you gross profit minus the variable, selling, and administrative, and minus the fixed selling and administrative. The fixed overhead is part of the $40 product cost. So absorption-based net income is $22.88. Variable costing, sales at the $100 per unit. The variable cost of goods sold is at the $30 product cost. You also subtract the variable selling and administrative at $4 per unit before you come up with your contribution margin. Then you subtract all of the fixed selling and administrative and all of the fixed overhead to come up with your variable costing net income of $23.18, and absorption was $22.88. Okay, production is less than sales. So absorption-based net income of $22.88 is less than variable costing of $23.18. Okay, we produced 45, we sold 48, that's right. So the difference is 3 times our $10 fixed overhead rate for a $30,000 difference. So if I take the $23.18 and subtract the $30,000, I get the $22.88. Okay, production, the same sign for absorption based as opposed to variable costing. Okay, so now let's do the easiest one. Production equals sales. Absorption-based net income equals variable costing. So production is 50, sales are 50. I went back to the $500,000 for fixed overhead so that I would have the $10 per unit overhead, fixed overhead price. Absorption costing, sales minus cost of goods sold, again at my $40 product cost, gives me gross profit. Then I subtract my variable selling expenses and my fixed selling expenses. And I get absorption-based net income of $2,400,000. For the variable costing, sales at $100 minus my variable cost of goods sold at the $30 product cost. Subtract the variable selling and administrative because it's a variable cost to come up with contribution margin. Then subtract all of the fixed selling and administrative and all of the fixed overhead. And I get a variable cost net income of $2,400,000. Absorption based is $2,400,000 because production of $500 equals sales of $500, and the difference is 0. There you go. Okay, I hope that was helpful to you. You can look at it as many times as you need. These are the key concepts and the 3 different types of examples that you can run into. So I wish you the best with learning that material. So go practice that homework. All right, bye.